We've got the management of Coforge joining us on the show. It's a very strong performance. Revenue growth came in at 5.9%. Margins expanded to 14%, as has been the company's guidance. And they're talking about a robust H2 as well. Sudhir Singh, CEO of Coforge, will now be joining in. And some of the things that we'd like to discuss with him is what's driving this confidence about the second half of the year, the outlook on margins after the company's achieved 14%, and what beyond the $2 billion revenue run rate that the company had put out, because now it's within sight now. Sudhir, thank you very much for joining in. This is Rima here. Tell us about H2 and how you see it. You sounded very confident in the call, but because Q3 is a seasonally weak quarter, but you expect a bounce back in Q4. I mean, what are we looking at?
I think you put it very aptly. Q3 is a seasonally weak quarter. We believe the entire year, given what we've already logged at the end of H1, which is almost 26+% growth, is going to be an extremely robust year. There will be the usual moderation that happens in Q3, and then we would expect things to normalize in Q4. We expect, on the whole, fiscal year 26 to be a robust growth year for the firm, as we'd indicated at the beginning of this year as well.
And on margins, now you're talking about 14% margins at an aggregate basis for FY26. Is that correct?
That's absolutely right. And we, incidentally, you would have noticed this, we've logged in 14% EBIT in quarter two itself, which was almost 250 bips higher year on year. Our outlook for the full year again is 14% EBIT, and it's our intent to make sure that we get there.
Okay. And what will be the impact on account of wage hikes in Q3 on your margins? And you also spoke about how that beyond 14%, you don't plan to expand margins. The priority will be on growth. So take us through that too.
Right. Quarter three, we've already declared annual increments for the entire workforce effective the 1st of October. That's going to be a headwind. There are also tailwinds on the margin front because the ESOP cost is going to fall materially in quarter three again, just as it did, and just as it fell in quarter two. So quarter three, with the wage hikes, which will be a headwind, with the tailwind put together, we'll try to make sure that we turn in numbers that across quarter three and quarter four land us at the 14% that we need to land at.
All right. Hi, Sudhir. Good morning. Good to see you, Ben. Quick question. 80 basis point margin expansion is what we saw in the last quarter. How much of it was because of the rupee depreciation?
There was an element of the rupee depreciation in play, but the one thing that I do want to call out about our results is we also take our hedge losses and gains to the top line. We had a headwind of 78 bips because the hedge losses this quarter were higher. So we had headwinds of 78 bips because on account of the hedge losses higher than quarter one. We had a tailwind of 20 bips because ESOP costs were lower. In total, our net headwind was 58 basis points. And after that headwind, we have reached the 14% EBIT that we did call out for quarter two.
Okay, all right. So that's encouraging to hear then. You're already going at a run rate of around $1.8 billion approximately. You were talking about around $2 billion, right, in FY27 at some point of time. Is there a possibility next couple of quarters you move to that $500 million a quarter run rate, which in turn means that you've got to the $2 billion run rate?
Well, we don't give a revenue guidance, but obviously, as you can imagine, the intent is to get to the $2 billion run rate at the earliest. We believe, within sniffing distance of that $500 million per quarter, which is the $2 billion annualized run rate. The intent is to keep the feet on the pedal and to get to that at the earliest possible.
Sudhir, hi, great to have you with us on the show again. Investors pretty happy with the performance, and it's been so steady, right? I think another thing that the street is taking heart from is that this whole issue about the free cash flow and your investments and the whole confusion around the data center, that's a thing of the past. Correct me if I'm wrong, but the numbers that I have suggest that your free cash flow is back to about 37 million. So what is the guidance on the free cash flow and future investments, data center or otherwise? And just talk to us what this whole AI pivot will also mean, because I think you made a reference towards this even in the investor call. So tell us about some of this in the future investments.
Well, free cash flow, you're right. Our free cash flow to PAT for the quarter was 86%. our guidance on a go-forward basis is that it will be our intent to keep the free cash flow to PAT metric somewhere between 70 to 80% on an ongoing basis. As far as AI is concerned, we've always said this, and we continue to maintain this, that what has differentiated us and our performance over the last 4 years has been an execution intensity that is uniquely our own. We've always said this, execution is not just about sharing plans or strategies and sharing them in public. It's more about making sure that what you share actually gets done. There is no place which exemplifies this ability of Team Coforge to bring execution to life than in our ability to not just embrace AI in our internal operations, but also to be able to create our own IP, our own frameworks, which we have, which are the ones that are actually driving the transformation that we are seeing and the revenue uptick that we talk about. When you look at Coforge, Code Insight AI, which is our platform, is the platform that we're using for some of the largest reverse engineering pieces of work that we're doing with code right now. When you look at Forgex, we're using that platform, again, our platform to drive transformation at scale. And if you consider Blue Swan, which is our orchestration and automation AI-based platform, that again is driving it. So AI, for us, our ability to embrace it, our ability to bring it to life and not just talk about it.
No, absolutely. No, absolutely, Sudhir. And that is driving the kind of revenue momentum that we're seeing. But what I'm just trying to understand is that from an investment point of view, whether it's organic or inorganic, is there a specific AI/data center related additional investment that you see ahead on the horizon that you can call out?
Absolutely not. There's going to be no further AI data center related investment that the investors should expect. And we were very categorical about that in our investor call as well.
Sudhir, just to get back to the point about growth and margins. Now, you've said the focus will be on growth rather than pushing margins beyond 14%. But at what point will that change? Will it change when the company's top line hits $2 billion, as is the first goalpost? Or would you like it to, say, hit $3 billion before you will look to also simultaneously expand on margins? Because some of your peers are operating at higher margins.
Well, I wish to be very clear. We haven't said that the intent is not to move beyond 14%, but what we did say and what I did say at the beginning of this year was that our first goal for fiscal year 26 will be to hit an EBIT of 14%. We feel confident with that guidance at the current point in time because quarter 2 EBIT itself was 14%. Having said that, we believe that once the 14% EBIT baseline is secured, that's the minimum threshold by way of ambition that we will retain for us on the margin side. The primary imperative is going to be growth, if possible, industry-leading growth, as we clocked in FY25 and are likely to clock in FY26. EBIT will increase, but we aren't giving an EBIT increase guidance. As far as we are concerned, the pecking order is very clear. After we hit 14% EBIT, growth will be the primary imperative. EBIT, of course, given the operating scale-up that will happen, will continue to inch upwards.
All right, so the final couple of questions before we let you go. Why are the deal wins stuck at around $500 million? And now with Sabre fully ramped up, do you think there'll be a slowdown on deal wins? So you could give us some kind of color with regard to deal wins on a quarterly run rate. And also your interest cost, it's holding around 40 crores per quarter. I think your total debt in your books is around 650, 700 crores. Explain this to us because that's an annualized interest cost of around 160 crores. I'm guessing there'll be some stretched working capital there. Go ahead.
Sure. I think why only $500 million is somewhat uncharitable because we hit the $500 million benchmark very recently. If you go back 2 years, the firm used to clock an order intake on an average of $300 million. So over the last 2 years, that number has moved dramatically. 500 million is a number that we take a lot of pride in. The intent is to keep inching upwards. But at this point in time, if you look at the next 12 months signed order book of Coforge, that is 26.7% higher than where that signed order book was just a year back. So 500 million, the intent is to continue pushing it upwards. If you look at our large deals, even in Q2, we've signed 5 large deals. In the first half this year, we've signed 10 large deals, contrasted with 14 that we signed through all of last year. So our large deal velocity is going up. Large deal median size is going up. And I think it's a matter of time before the 500 becomes a 600 or a 700. But as always, we aren't giving a timeline or a forecast around that.
Okay. All right. And the interest cost, you just want to comment on that?
I wouldn't have the numbers handy with me, so I can't give you those numbers offhand.
Okay. All right. Sudhir, thanks a lot for joining in. Good quarter. Sounding optimistic about the future as well. We'll track you to a few of these numbers that you've given us. Wishing you a good day ahead and a good quarter ahead as well.
Thanks very much.